Hey, what's up, guys? In just a matter of time, United States economy might turn into zombie economy just like in Japan. In this video, I will explain why this could happen, then we will take a look at the recent J Powell update on our economy, and finally I will explain why the stock market bubble may pop soon. This video is brought to you by NordVPN/Aimstone. VPN is a private network that allows you to stay private and anonymous on internet. NordVPN is secure, fast, and very easy to use. It has over 5,200 different servers in 59 different countries. This makes streaming videos and blog content a walk in the park. Netflix streaming works with over 90% of servers. This is the highest I have ever seen. Since they have so many servers, it is easy to find fast-performing server. Another very important feature, NordVPN keeps no logs of user activities online. You can secure up to 6 devices to new account, which is not something very common with other VPNs. When connecting to NordVPN, it will automatically select the best server for you, but you can also choose a different server across the globe if you like. Addition to that is very affordable. To get the best deal, use the coupon code Aimstone and you will get 70% off 3-year plan plus 1 additional month free. That's only $3.49 a month. Use the link in the description box below, nordvpn.org/aimstone, to get this sweet deal. Stock market suffered their biggest one-day pullback in 3 months on Thursday as many investors grew concerned about the number of these illness cases increases. Some states are reopening up from lockdown, while the surge of recent cases going up. This could also be the beginning of the second wave, but only time will tell the truth, so we will have to wait and see. If we look at S&P 500 on Thursday, it dropped by 6% and high volatility spiked again. Also on Thursday, the chairman of the Federal Reserve, J Powell, gave the press conference about our current economy, and many investors probably did not really like what he had to say. Let's take a look at this segment, what J Powell said about the economic future expectations.
Forceful measures taken to control its spread have induced a sharp decline in economic activity and a surge in job losses. Indicators of spending and production plummeted in April, and the decline in real GDP in the current quarter is likely to be the most severe on record. Even after the unexpectedly positive May employment report, nearly 20 million jobs have been lost on net since February, and the unemployment rate has risen about 10 percentage points to 13.3%. As was highlighted by the Bureau of Labor Statistics, this figure likely understates the extent of unemployment, accounting for the unusually large number of workers who reported themselves as employed but absent from their jobs would raise the unemployment rate by about 3 percentage points. The downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been the most affected. In particular, the rise in joblessness has been especially severe for lower wage workers, for women, and for African Americans and Hispanics. Weak demand, especially in sectors most affected by the pandemic, is holding down consumer prices. As a result, inflation has fallen well below our symmetric 2% objective. Indicators of longer-term inflation expectations have been fairly steady. The extent of the downturn and the pace of recovery remain extraordinarily uncertain. We all want to get back to normal, but a full recovery is unlikely to occur until people are confident that it is safe to re-engage in a broad range of activities. The severity of the downturn will also depend on the policy actions taken at all levels of government to provide relief and to support the recovery when the public health crisis passes. The Fed's response is guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. We are committed to using our full range of tools to support the economy in this challenging time. In March, we quickly lowered our policy interest rate to near zero, where we expect to keep it until we are confident that the economy has weathered recent events and is on track to achieve our maximum employment and price stability goals. We're not thinking about raising rates. We're not even thinking about raising rates. So what we're thinking about is providing support for this economy. We do think this is going to take some time. I think most forecasters believe that. it would be great if we got a whole bunch more months of job creation like that. Notwithstanding that, as I mentioned, there are just a lot of people that are unemployed, and it seems quite likely that there'll be a significant group at the end of even after a lot of strong job growth that'll still be struggling to find jobs, and we'll still be providing strong accommodation for that. When the time comes, after the crisis has passed, we will put these emergency tools back in the toolbox. Clearly, not everyone will go back, but I would say many will go back. But what's going to be the remainder when when we reach sort of what is the new normal? It's so uncertain, but it could be a good number of millions of people, I think, in many estimates. But I'd say you're so early in the process. For example, people are going back and looking at other significant changes in the economy, and they've seen how many people go back when, for example, there's technological change and things like that. You may have seen some of this research, and you come up with an estimate. It's just going to be very hard to say. My assumption is that there will be a significant chunk well into the millions. I don't want to give you a number because it's going to be a guess, but well into the millions of people who don't get to go back to their old job, and in fact there may not be a job in that industry for them for some time. There will eventually be, but it could be some years before we get back to those people finding jobs. I mean, when people lose a job, if they can find a job in their own industry, that's usually the fastest way, is they know other people in that industry, different kinds of jobs. That's usually the fastest. If you have to go to a different industry and start over again, it's much harder, and that's where you start to lose people who are just fall out of the labor force, and it's very tough on their lives. We all know people to whom that happened in the global financial crisis, and hence our desire to do what we can to support this and support this recovery with the tools that we have.
First, J Powell said there have been 20 million job losses since February. Not sure what number he is looking exactly, but only last week another 1.5 million people filed for unemployment benefits. This makes the total jobless claims 44 million. Adding to that, the real unemployment rate isn't in 13 or even 16%. I think the real unemployment rate is in 20%. These current jobless claims dwarf other numbers of job losses in any other financial recession in the history. Another very concerning factor that Fed used all the monetary power to artificially prop up the economy. $3 trillion as a stimulus package is the thing of the past, plus the current interest rates are at 0%. I do understand that they're not thinking about raising interest rates, but keeping at 0% for another decade will turn our economy into a zombie economy just like in Japan. Japan has been keeping the interest rates at zero near for almost 25 years, and in recent years the rates dropped to negative territory. So they tried to save the economy from collapsing, but what they did, they just created zombie economy through 0% and negative % interest rates. Let's take a look at their GDP level. From 1970s till mid-1990s, their economy was booming while interest rates were high. But since they dropped the rate, GDP level is stagnant. GDP hasn't really grown for the past 25 years. Japan is highly in debt from all those debt buying back programs. Debt to GDP level is at highest in the world, is a staggering 250%. I do not think they can much longer kick the can down the road. They need to default on their debt and press the reset button and start from the beginning. It looks like the United States is on the similar path as Japan. Interest rates have been negative for the past decade. J Powell just admitted that interest rates will stay at this level for another decade most likely. Printing money, buying treasuries, mortgage-backed securities, and now corporate debt will spike the US debt to unprecedented levels. Right now, our debt to GDP level is over 110%. We're not quite where Japan is, but we're getting there. Most importantly, that our GDP growth was increasing year after year. There was a consistent positive growth in GDP levels. But if the massive money printing will continue and the interest rates will remain at 0% for another decade, United States economy might as well turn into zombie economy just like in Japan. From my last video I explained why we have to start feeding the animals and why we need a real capitalistic system with free marketplace. Let's take a look at J Powell's response when he was asked by the journalist if there could be a possible bubble blowing into the stock market that could pop.
Since your March 23rd emergency announcement, every single stock in the S&P 500 has delivered a positive return. And I'm wondering, given the levels of the market right now, whether you or your colleagues feel there is a possible bubble blowing that could pop and set back the recovery significantly, or that we might see capital misallocation that will leave us worse off when this is over.
From that point forward, investors everywhere in the world for a period of weeks wanted to sell everything that wasn't cash or a short-term treasury instrument. They didn't want it to have any risk at all. And so what happened is markets stopped working. They stopped working and companies couldn't borrow. They couldn't roll over their debt. People couldn't borrow. So that's the kind of situation that can be very financial turbulence and malfunction. A financial system that's not working can greatly amplify the negative effects of what was clearly going to be a major economic shock. So what our tools were put to work to do was to restore the markets to function. And I think some of that has really happened, as I mentioned in my opening remarks, and that's a good thing. So we're not looking to achieve a particular level of any asset price. What we want is investors to be pricing in risk like markets are supposed to do. Borrowers are borrowing, lenders are lending. We want the markets to be working. And we're not looking to a particular level. I think our principal focus, though, is on the state of the economy and on the labor market and on inflation. Now, inflation, of course, is low, and we think it's very likely to remain low for some time below our target. So really, it's about getting the labor market back and getting it in shape. That's been our major focus. And I would say, if we were to hold back, because we would never do this, but the idea that just the concept that we would hold back because we think asset prices are too high, others may not think so, but we just decided that that's the case, what would happen to those people? What would happen to the people that we're actually legally supposed to be serving? We're supposed to be pursuing maximum employment and stable prices, and that's what we're pursuing. I would say that, we're tightly focused on our real economy goals, and again, we're not focused on moving asset prices in a particular direction at all. It's just we want markets to be working, and I think partly as a result of what we've done, they are working, and we hope that continues.
J Powell indicated that their intention was not to blow up a stock market bubble, but to get the economy going because it stopped working. And with their tools, aka printing money, was the main intention to restore the market functions. I'm not so sure if this is really the case. If we go back till 2008 global financial crisis, we can clearly see what impact of printing money had on the market. It just inflated the stock market, and the same we should expect in this situation. I think we are in the bubble, and to have more or less healthy environment, the stock market has to be at the level or below level of GDP growth. Right now, the stock market is at least 140% higher than GDP level, which means the stock market should drop by 40% to meet the GDP level. I do not think this is going to happen in 2020 unless we see a second wave of this illness. If not, Fed will keep the stock market moving until after the election day, and sometimes in 2021 we should expect a pullback. Let me know, what do you guys think about J Powell and the current economy? Do you think we are in the bubble or not? Leave your thoughts in the comment section below, hit that like button and subscribe.